Hello, my name is Bob Steele. In this video, we will continue on Chapter 2, starting with Objective 7, which is to understand the importance of identifying an organization's cost drivers. So, activities that cause costs to be incurred are called cost drivers. So, there's two types of things we're going to take a look at cost drivers. What we're trying to find out is the thing that will most accurately predict the cost that will happen so that we can, one, allocate costs between maybe two departments in some way, or make some predictions about costs that will be incurred in the future. So in order to do that, for example, if we're talking about machining operations, the cost driver might be machine hours. So we might try to estimate the machine hours, or we might take a ratio of machine hours if we're trying to allocate machine hours to different products or different inventory. And then we have setup time. So of course the setup time might be setup hours rather than machine hours. That would give us our cost driver. If we're talking about production scheduling, manufacturing orders, so we might count the manufacturing orders in order to come up with a ratio to allocate those costs to different departments. Inspection time, we might look at pieces inspected. So if the inspection time, again, is looking for a cost driver, the thing that really drives that, if we count the pieces that would be inspected, that would be the way to allocate those costs out. Purchasing, we might look at purchase order, the numbers of purchase orders, and once again we might use that in order to allocate costs between different items. Shop order handling, we might look at shop orders. Value assembly support, so the support items. Customer requisitions might be the thing to allow us to take a look at the driving factor of those costs in order to, one, maybe allocate the cost between different products and different departments, or to estimate the cost that will be incurred in some way or another. Learning Objective 8, describe the behavior of variable costs in total and a per unit basis. So we're going to take a look at variable costs and fixed costs and look at their behavior. So cost behavior means how a cost will react to changes in the level of business activity. So total variable costs change when activity changes. Total fixed costs remain unchanged when activity So the example of variable costs, of course, would be things like material, for example, that would go up with the production. So the material would go up at a constant rate if we produced more things. On the other hand, fixed costs, the example I like to use is the rent. The rent basically stays the same. So if we produced more things, the overall cost of the rent will stay the same. So if we look at it in this fashion, we're going to say total variable costs. Your total cost per pay-per-view bill is based on how many movies you watch. So if you buy movies and do it on a pay-per-movie basis, and whatever that rate is, let's say it's $4 a movie, then your bill, the total pay-per-view bill, will go up in a direct proportion to how many movies you watch. So it'll go up directly by $3 each time you purchase a new movie. Variable cost per unit example, the cost per movie watched. So if we take that same example, but now on this axis we are putting the per movie change, and in this axis we're having the movies watched. In this case, the movies still cost the same amount each time. So in this case we said $4 per movie. So no matter how many movies we watch, each movie is costing us the $4. If we contrast that with fixed costs, your monthly cable bill probably does not change when you watch movies on channels that have elected to be paid for. So if you're watching on like an HBO channel, then you can watch as many movies as you want. You can stay home all day long and watch movies, and your HBO bill would remain constant. So whatever your monthly cost is would remain the same no matter what the number of movies that you watched would be. So we're comparing that to the first graph we looked at for variable costs. Then if we take a look at the average cost per HBO movie decreases as more HBO movies are watched. So monthly HBO bill here for what is watched and the number of HBO movies here, that means that the cost per movie goes down the more movies we watch. So that's, many of us has probably thought that way. If we have an HBO channel, we might be thinking, well, I don't watch it enough to pay for the HBO. That's because we know if we watched more of it, then of course we would be getting cheaper movies on average, basically, because of that fixed rate method. So this difference between variable costs and fixed costs will cause us to have some issues that we'll have to deal with, because when we talk about the manufacturing process, we have both variable costs and fixed costs in the manufacture of the products. And when we try to estimate and predict and think about different types of options going into the future, the cost behavior is going to need to be allocated in such a way that it will account for the different behaviors of the costs in that production process in order for us to make an accurate prediction. So cost classifications. So we have variable costs is just a chart to summarize what we just looked at. And variable cost, total variable cost changes as activity levels change. Per unit, the variable cost per unit remains the same over a wide range of activities. Fixed costs, on the other hand, total fixed cost remains the same even when the activity level changes. So the rent stays the same no matter how much the activity level is there. On the other hand, the fixed cost per unit goes down as activity levels go up. And this is really the concept that I think most people have to kind of think about to wrap their head around, right? The fixed cost, the cost per unit is going down. The variable cost, the cost per unit is obviously constant because we're talking about the same unit costing the same amount each time. So that difference is what we're going to have to take a look at. Learning objective number 9, distinguish among direct, indirect, controllable, and uncontrollable costs. So direct and indirect costs. So direct costs, costs that can be easily and conveniently traced to a product or department. So cost of paint in the paint department of an automobile assembly plant. So obviously if we're talking about automobile assembly and we talk about direct materials such as paint, it's pretty easy to know that the paint is applied to that department and even that particular product and car. It gets more tricky when that's not so clear. So indirect costs, costs that must be allocated in order to be assigned to a product or department. So for example, a cost of a national advertisement for an airline is indirect to the particular flight. So if we're just talking about advertising, we have a national airline and we have all these different flights happening and these different departments that we want to allocate this cost to of advertising to, then the question is, how are we going to allocate it to one airline versus another airline? And we're going to need to use some ratio to allocate the costs out, and that's where these activity-based costing will take place. How do one air traffic might be larger than another, and we need to somehow account for that difference and allocate these costs out. And that's often when we use these activity-based drivers in order to come up with ratios that will be most appropriate. So controllable and uncontrollable costs, a cost that can be significantly influenced by manager, is controllable. So when we talk about controllable or uncontrollable, what we're saying is this something that can be managed by the local manager, and therefore should that manager be held accountable for those costs? And once again, we're going to allocate costs that are uncontrollable to certain departments so that we can see that allocation, because the cost in a whole is benefiting that department. But when we assess the performance of the department and the performance of the manager, it would be unfair to assess them on costs that they can have no control over. Therefore, we're going to try to break this out between costs that can be controlled and costs that cannot be controlled. So costs of food used in a restaurant, that would be a restaurant manager, and it's controllable. So the food that we use, the restaurant manager, we can budget that, we can see it, the manager should be held accountable for that. Costs of national advertising by a restaurant, that's something that, of course, the restaurant manager does not have control over. We're going to allocate that cost to that restaurant, but when we assess the performance of the manager, we really should not be taking that into account when assessing their performance. Learning objective number 10, define and give examples of an opportunity cost, an out-of-pocket cost, a sunk cost, a differential cost, and marginal cost, and average cost. So Opportunity cost, the potential benefit that is given up when one alternative is selected over another. So for economic terms, we basically would say that every decision has an opportunity cost, meaning the cost of the second best thing you could have been doing if we're just talking about time. Opportunity cost is not usually accounted for in the accounting books. When we make managerial decisions, though, we need to account for it. So if you were not attending college, you could earn $30,000 a year. Your opportunity cost of attending college for 1 year is $30,000. So when we think about the cost of college, we need to think about both the cost that is going into it, the future benefits that will be accumulated from it, but we also need to, and that would be the accounting kind of thinking of it, but we also need to think of the opportunity cost of the second best alternative, which in this case they're saying would be $30,000. That's also included in the cost of every decision that we make. And these are costs, of course, that normally our decisions are pretty good. Now there's some decisions that where our decision-making processes get a little tied up, and opportunity cost is one of those where we kind of need to put some more thought into it to realize those costs. Another one is called sunk costs. So this is another one where we tend to think about the costs that we made in the past, even though those costs are done and they can't affect us in the future. But because we've made them, we have the term of putting good money after bad, and that's the idea that we're chasing a sunk cost often, and it's one of those problems that everybody, we just need to think about those, because it's one of those types of problems that we can easily fall into. So all costs incurred in the past that cannot be changed by any decision made now or in the future are sunk costs. So sunk costs should not be considered in decision making. So the sunk costs of the past really shouldn't be considered in making the future costs. So we shouldn't be saying, well, we already put all this money into this, therefore we should put more money into this if at this point in time we have decided that it's not a wise decision. That'd be kind of, so you bought an automobile that cost $22,000 a year ago. The $22,000 cost is sunk because whether you drive it, park it, trade it, or sell it, you cannot change the $22,000 cost. So after the car is purchased, it's been purchased. Whatever you do with the car at this point forward the decision should be made separate from the $22,000 that was spent. Now you might be thinking, well, I could still sell the car, and that's true. That's one of the options that we could make from here forward, but we're probably not going to get sell it for the $22,000 going back. We're going to sell it for some depreciated amount going here, and that decision should be made separate from the original decision. Differential costs that differ between alternatives. So if for example, you earn $1,500 per month in your hometown or $2,000 per month in the nearby town, your commuting costs are $50 per month in your hometown and $300 per month in the other city. So, and we're just focusing here on the costs, not the difference in income. So the 300 minus the 50 is the differential cost in this case. So now we're going to talk about marginal cost and average cost. So the extra cost incurred to produce one unit is going to be the marginal cost. And the marginal cost could differ from the average cost. When we're making decision-making processes, oftentimes we want to think about the margin. We want to think about the costs of the next unit rather than the average cost of the entire units. So when we're making decision-making processes, oftentimes we want to use the marginal cost in order to make those next decisions. The total cost to produce a quantity divided by the total quantity is the average cost. So the average cost would be the average cost over all the production, and those things could change, and marginal average costs are largely a function of cost behavior, variable costs and fixed costs. So, the difference between the behavior, the marginal cost, and the fixed cost is what could cause the marginal cost to differ from the average costs, and we need to be aware of that when making the next decision. So cost and benefit information. So notice that we're going to get into some pretty detailed cost analysis and allocation of costs, and it's going to be good to know these types of allocations because it's good for just critical thinking skills, decision making, and just logical thinking processes. But of course, to do this in real life, that would be gathering a lot of information as well. And it's not always true that more information leads to a higher profitability. So there's always going to be a cost-benefit analysis, because remember, this is managerial accounting. We're trying to do what's best for management. We're trying to do what's best for the company. And getting bogged down in more information than is needed to make relevant decisions would not be the best thing for the company. So that balance needs to be found in terms of, how much information do we need to make the best decision, or, a good decision, right? And that's it for Chapter 2. Thank you.